Welcome back, options traders. Jake here. In this video, let's talk about an advanced options trading strategy I did converting a long call position into a credit spread. So currently in my Schwab account, this is what I've done with my position in Texas Instruments. In a video I made for you guys a couple days ago, I turned a long call position I had in Apple into a risk-free debit spread. You can check out that video if you want to catch up. But with a debit spread, the calls that you buy are below the calls that you sell. And with a credit spread, you're just reversing it. So with Apple, you can see the calls that I bought have a strike of 150. The calls that I sold have a higher strike of 175. With Texas Instruments, I've now done the opposites. This is what makes it a credit spread. The calls that I've sold with a strike of 180 are below the calls that I bought with a strike of 190. So why would I do this? Well, first let me give you my initial investing thesis when I got involved with Texas Instruments. The stock had uptrended nicely in 2020 and 2021. However, it hit this level of consolidation where the share price was range bound between 180 and 200 for almost 10 or 11 months. And I thought as soon as the 200-day moving average caught up to the share price of the stock, it would start uptrending again nicely. So on November 8th, when the share price of Texas Instruments was 189, I bought call contracts with a strike just out of the money. So the strike was 190, hoping that the technicals would support Texas Instruments to start going trending up. However, that didn't happen. So let me just give you the stats real quick here. Once again, two contracts. The cost per share, $19.36 per share. So I paid per contract $1,936. However, the current value of these contracts has gone down by 39%. They're only worth $1,163 currently. If I were to hold these contracts until expiration, which I never do, my break-even price would have been $209.36. So what happened here? And what happened here is the market has just obviously transitioned to pricing in slower growth in the future. And once the technicals turn on a stock, people aren't going to just join in an uptrend if the buyer's support isn't there. So you can see with Texas Instruments, it's creating a peaked here, lower high, lower high, lower high, lower high, lower high, lower low, lower low, lower low. So this is definitely going lower. Now, because this is such a well-known, profitable company with almost a 3% dividend yield, I don't see it going much lower, especially when they're reporting good quarters. So I think Texas Instruments will continue downtrending for the next couple weeks or maybe couple months, but eventually find price support at around 150 or 160. So I'm currently down 30% on these calls. The easiest thing that anyone can do is just get rid of them. Just sell to close. But what if you want to keep monitoring this stock? Because eventually, I feel like in 6 months, 10 months, a year from now, Texas Instruments will be trending up again as the company is doing well. So I got involved with this credit spread where I sold calls with a strike of 180, so right here, out of the money, when the share price of Texas Instruments was 172. So what the heck is going on here? Let's review the stats here. The cost per share of the contracts I sold, my account went up in cash value by $3,000. However, my account value doesn't go up because these calls that I'm selling have negative value in my brokerage account. But I was able to receive payment for the premium of $3,000 today. And once again, the break-even doesn't really matter here because I've created a debit spread. So what is my max loss on this position? And you can just think about it. To buy these calls with a strike of 190, I paid $3,871. I then sold calls against them. These calls with a strike of 190 are acting as collateral with my broker, so I'm allowed to sell calls against them even if the strike is below and I'm receiving a larger payment. That's why it's a credit spread, because if I opened these at the same time, I'd net be receiving a credit for the entire position. However, Texas Instruments went down, so the credit I got for the calls that I sold is only 3,086. So, if Texas Instruments continues to downtrend, these calls have more remaining value, extrinsic value. They will lose money faster than my farther out of the money call contracts that I bought. And let's pretend I'm completely wrong and Texas Instruments stays below the strike of 180 for the rest of the year, all the way through expiration January 2023. Well, in that case, everything goes to zero. All four of these contracts are out of the money. Everything expires worthless. What is my max loss on this trade or this position now? And it's the difference between these two values. So $785 is the most I can lose from getting involved with Texas Instruments. Whereas before being down 39%, my position here had to have been down close to $1,500. However, what if once again I'm completely wrong and Texas Instruments immediately shoots back up, goes straight to $200, and I'm now trapped in this credit spread position? Well, that would be very bad for me because I can lose an additional $2,000 from the $700 that is the difference between these cost bases. The reason why is at expiration, all four of these contracts would expire in the money, and I would immediately be buying 100 shares per contract for 180 and then selling to somebody else for 190. If they all triggered at the same time with my broker after hours on January 20th, I'd be buying 200 shares at 180, then selling to somebody else for a loss, 200 shares at 190, losing me an additional $2,000 worth of value. But I'm getting involved in this trade now because I don't think that's going to happen. I think Texas Instruments, the technicals don't look favorable for it to just break out of nowhere. They're not reporting earnings for another like 2.5 months. So I can see the share price of this company continuing to create lower highs, lower lows, until it gets down to about 150 or 160. At that point, it'll find price support because it pays a pretty good dividend. As soon as the technical lines, the moving averages, catch up to the share price of the stock, that'll signal that this stock is good to start uptrending again. At that point, guys, when the first full candle fills above all four of the major moving averages, I will let's see here. I will buy to close these contracts at 180 for whatever profit I can get from theta decay and share price movement in the down direction. I then will hold on to the calls that I bought, hoping Texas Instruments can start uptrending again much later this year. The price will rebound. If I can get closer to 190, I can get back most of the value of these contracts. So the goal, once again, share price movement, I can buy to close for a net profit and then hold the calls that are farther out of the money until they can recover. So in the event you buy long calls in your brokerage account, selling calls against them, whether below the strike that you bought or above the strike that you bought, I've shown you two different methods you can use. And selling calls against your long call positions is really nice because it basically freezes your losses if there is a broader market panic. And I could have done this when the market started selling off. You could have looked at any technical indicators and they would have shown you that the market was downtrending and it definitely could have gone lower. In addition, you just kind of get the feeling when fear is in the air, and you can watch other finance YouTubers or CNBC or whatever, and everybody's trying to scare you into selling at the bottom. So I could have sold calls, and I might try and time this just a little bit to squeeze a little bit of value. So if you sold calls against all your positions here, maybe 2 or 3 days later, buy them back, you don't know how much farther it's ever going to fall. But you know when you're in the middle of it, and potentially it can keep going lower. Obviously, the market is rebounding nicely. It's been green the last couple days. So the last thing I want to mention in this video, because I keep getting this question, is why not sell monthly contracts, Jake? You keep selling calls with the same expiration dates as the calls that you bought. Can't you make more money if you're selling weekly or monthly calls against them? And this is actually counterintuitive, but I don't think so. If I were to successfully sell a call against these calls every single month, yes, I am accumulating more value from theta decay over 10 months. It would be more money. But if I only think Texas Instruments is going to downtrend in the next 5 weeks to 2 months, then selling a farther out call is actually more money for me. The reason why is because price movement is more valuable than theta decay. So think about it. One of these contracts that I sold with a strike of 180 is $1,543. I looked at the 1 month out call contract that I could have sold for Texas Instruments, and it was $250. So let's pretend over the next month I'm right. Texas Instruments downtrends to 160 or 150. Well, if I sold a monthly call contract, I would have made $250. But if these calls for January of 2023 lose 50% of their value, I can make $750. So farther out calls sold against your long calls, if the share price moves more dramatically, it's more money. But if the share price stays perfectly flat, then yeah, theta decay on a monthly call contract would be more money. Just wanted to highlight that difference for you guys. Okay, that's all I got for this video. If you enjoyed it, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I'll help you if I can. Till the next video, take care.